All right, buckle up, buttercups. Oil just dropped a plot twist big enough to flip portfolios. Cue the intro music and flashing ticker graphics. Welcome back to LKC, where every Sunday we break down one story that can move your money. This is information and opinion only, not financial advice. Keep compounding. Picture Riyadh's conference room A, satin drapes, crystal water glasses, and a single polished gavel. On Saturday, May 3rd, 2025, that gavel came down with one decisive thwack. OPEC Plus, the cool kids table of crude, decided it was done with drip-feed discipline. Instead of unwinding supply cuts over 2 sleepy years, the cartel will add 411,000 barrels a day in June and says the full 2.2 million barrel holiday could be gone by October. Traders instantly branded the move the Saturday night surprise, and a surprise it was. Markets opened Monday and face-planted. Brent crude slid to $60 and change, its weakest settle since early 2021. West Texas Intermediate followed to 57 and some spare pennies. Energy trading desks watched price candles bleed red like a horror marathon. Risk teams rewrote books mid-sip, probably spilling iced coffee on the keyboard. Yet the cheers from airline HQs could drown out the groans from oil majors. Cheaper jet fuel is suddenly on sale, and balance sheets love a sale. Why would Saudi Arabia, undisputed heavyweight champ of the oil ring, flip the chessboard? 3 motives: discipline, diplomacy, and dominance. First, discipline. For nearly 2 years, Iraq and Kazakhstan treated production quotas like polite suggestions, together pumping roughly 2.4 million extra barrels. Imagine sneaking half the cookie jar after mom said 2 cookies max. Riyadh's patience thinned to razor wire. Prince Abdulaziz, mic firmly in hand, essentially declared, "If some won't cut, none will." He opened the desert tap and aimed the gush squarely at the quota rebels, squeezing budgets until compliance feels like relief. Second, diplomacy. Mid-May, Air Force One touches down in Riyadh carrying President Donald Trump, weeks from a vote hunt back home. Every president loves cheap gasoline on campaign trails. Delivering sub-$3 pump prices in time for the photo op buys Saudi Arabia political brownie points, plus a friendly reminder to Washington that the spigot still sits in the sand. Third, dominance. Veteran traders recall 2014, when Riyadh drowned infant shale drillers in cheap crude. Back then, the marginal shale barrel cost $45. Today, private Permian operators need at least 55, some closer to 60, just to break even. At $60 flat prices, hedges blow out, rigs idle, and Saudi captures market share while funding its Vision 2030 megaprojects. Call it chess, chicken, or checkmate. The kingdom has played this board before. Zoom out to the reaction. The Energy Select Sector Fund lost more than 6% in 5 brutal sessions. Exxon, Chevron, Conoco, each printed weekly declines north of 7%. Meanwhile, the airline bundle nicknamed JETS rose just over 1% as jet fuel spreads collapsed. Delta, United, Southwest all gained altitude while the broader S&P mostly shuffled sideways. Macro geeks grabbed calculators. Every $10 move in crude historically shifts US headline inflation about 15 basis points within 6 months. $60 oil could offset tariff-driven goods inflation that has the Federal Reserve sweating through its wool suit. Sure enough, Fed funds futures pushed the odds of a September rate cut above 50% within 48 hours. Cheap oil just bought the economy a pocket of breathing room. Hop across the oceans. India imports 85% of its crude. Keep Brent between 60 and 70 through fiscal 2026, and New Delhi's Treasury pocket savings worth roughly $22 billion US. Turkey scores diesel relief. Thailand's tourism rebound gains tailwind on cheaper jet fuel. Refiners everywhere grin from ear to ear. When crude falls faster than gasoline, crack spreads fatten. $14 turned to $19 almost overnight. Tanker owners rejoice for simpler math. More barrels sailing equals more hire days. Very large crude carrier spot rates jumped double digits inside 2 sessions. But every coin flips. Offshore megaprojects in Uganda or Brazil's pre-salt need break-evens well above 55. At 60 flat, internal rates of return shrink to single digits. Boards defer final investment decisions. Shipyards postpone floating production holes. Equipment suppliers feel frostbite. Oil service giants read the room and tighten belts. Options activity on the main services ETF exploded as funds bought downside insurance. High-yield shale bonds, modeled on $70 decks, suddenly wobble. Leverage metrics balloon past covenant walls. Distressed debt desks sharpen pencils, ready for convertible rescue deals. To grasp the geopolitical stakes, follow budget math. Saudi Arabia needs roughly $90+ a barrel to stay fiscally neutral. Russia's target hovers in the high 70s. Iraq needs north of 90. Kazakhstan about mid-60s. Riyadh boasts deep foreign reserves and can sell long-dated sukuk to plug gaps. Baghdad baked $70 oil into a 3-year plan and now stares at a 3% of GDP crater. Moscow already trimmed projected oil revenue by almost a quarter and expects a deficit near 2% of output. Wall Street models updated overnight. Barclays chopped its 2025 Brent forecast to 66. Other houses swiftly followed. Consensus now erases roughly $70 billion in upstream cash flow compared with January spreadsheets. Reality check delivered. Rewind 6 months. Last December, the voluntary cuts were scheduled to fade gently until late 2026, unwinding at only 96,000 barrels a month. Saturday's vote crams 28 months of supply restoration into barely 5. Risk officers who left Friday with delta-neutral books arrived Monday to option surfaces twisted like taffy. Historical echoes matter. In 2014, Brent collapsed from 115 to under 40 in 8 months. Shale kept drilling thanks to zero-rate debt. Now, interest rates stand north of 5%, and private lenders pick winners with tweezers. Saudi Arabia is betting the pain will chop future non-OPEC supply far quicker this time. Inside OPEC politics, the spaghetti tangle tightened. Algeria and Nigeria argued for patience, fearing fiscal cracks. The UAE waved green flags, eager to monetize new capacity. Russia backed Riyadh. Volume today trumps price while sanctions discounts linger. Consumers ask, when do we see savings at the pump? Retail gasoline usually lags wholesale by up to 4 weeks. Early signs, US unleaded already slipped a nickel to 318. Australian wholesale levels hint at coming relief. European prices move slower, but direction is set. Shipping adjusts too. Product tankers hauling diesel from Gulf refiners to Asia grabbed fresh bids, pushing freight rates up nearly 10%. Cheaper crude ripples through climate talk. Critics warn sub-60 oil dulls appetite for electric vehicles and squeezes biofuel margins. Yet after the 2015 slump, solar and wind installations actually accelerated thanks to policy targets and plunging battery costs. Bloomberg NEF still sees solar capacity leaping 30% this year. Petrodollar recycling slows. When crude is rich, Gulf wealth funds gorge on treasuries and tech unicorns. When margins thin, that hose narrows, nudging global liquidity tighter, even as the Fed contemplates easing. Corporate boards recalibrate. One producer trims drilling 10%, another toots hedges struck at 62. A supermajor reminds shareholders downstream gains cushion upstream pain. Implied volatility in 1-week Brent options hit 45%, highest since the Red Sea drone scare. Asian national oil companies quietly shop parametric insurance that pays out if Brent closes below 55 for a month straight. Analysts churn new scenarios. Oxford economists think $60 oil could shave 3/10 off world inflation by December. Stanford modelers now peg non-OPEC supply growth 800,000 barrels lower than before, heightening future boom-bust swings. Freight investors eye convex payoffs in tanker indices. Bond desks note high-yield energy spreads widened 40 basis points. Inside OPEC, the next circle on the calendar is June 1st, the Joint Ministerial Monitoring Committee. If Iraq brings a credible compensation cut plan, fresh barrels may pause. If talks implode, Saudi could unleash the last million barrels and drive Brent into the 50s. Strategists debate whether this is economic leverage against Tehran and Moscow. Lower prices squeeze both without firing a sanction. Demand risk still lurks. Factory PMIs in Europe and China dipped into contraction last month. If industrial momentum fades, even today's bigger tap might look too open. Portfolio takeaway. Diversification is your shield. If energy weighs more than 10%, consider trimming. Travel, chemicals, and packaging margins stand to expand. Stick exposure to your risk tolerance and time horizon. Action steps? Check EIA inventories every Wednesday. Watch the rig count each Friday. Set alerts for Brent above 65 or below 55. Those guardrails will tell you whether Riyadh's gambit stays tactical or turns into a drawn-out price war. Remember, emotions matter. Write your plan, sleep on it, execute when calm. Cue the outro music. Tonight, we rode the oil roller coaster from Riyadh's golden gavel to your wallet to global geopolitics and back again. One headline wiped or minted trillions, yet disciplined decisions by nations and by you remain the true engine of wealth. Thanks for spending part of your Sunday with LKC. Share, rate, and wield these insights during your next portfolio review. Until next time, research relentlessly, question boldly, and keep compounding.